Glenn, great to have you with us, and we're digesting some pretty positive macroeconomic data from China, which was a tad unexpected, with the GDP numbers coming in at 6.9%. That's indeed a beat.
It is indeed a positive surprise, and I think most analysts, though they were forecasting Chinese GDP growth of 6.8%, did have their risk skewed to the downside. At ANZ, we actually thought the number could be closer to 6.5. And the reason for that is growth in the first half was very much supported by the services sector, particularly financial services, aligned with the share market boom we saw over that period. We were looking for a partial retracement of that. So the fact that growth has held up fairly stable at 6.8% is a positive sign for the market, or at 6.9%. And I think, what you are going to see is markets will once again be in that position where they're recalibrating their global view. At the end of last week, everybody was of the view China was slowing. The Fed had become China data dependent. The Fed was on hold. Asian currencies, emerging market currencies were rallying as a result of that. Now that we have evidence that the Chinese economy is perhaps not slowing that quickly, I think Fed rate hikes once again become a live option, particularly around December, certainly in Q1 2016. So some of that relief rally we've seen in emerging market assets and Asian currencies in particular may start to fade on this better than expected Chinese data.
So do you think Chinese data or the latest batch of economic data from China is a clear indication that China is slowing down, but the slowdown is slightly better than what everybody expected? Everyone had written an official obituary for China, but looks like there is still a lot of life left in that economy.
I think that what we're seeing is two things. One, the slowdown is tapering. Perhaps the steepest part of the slowdown is behind us. Two, a whole range of measures are now starting to gain traction. The new yuan loans figure we saw last week was better than expected. Liquidity is finding its way into the economy. Fiscal policy is starting to gain traction. We're seeing infrastructure packages start to work and start to be implemented. And more importantly, the residential sector also appears to be stabilizing. So I think perhaps markets are guilty of a little bit of over-bearishness on the outlook for China, and it appears that the slowdown on the headline figures is tapering.
Glenn, what is the expectation from the market, and what are the odds of that Fed rate hike and a lift-off in 2016? Is that pretty much what the street is factoring in, you think?
Look, I mean, it's difficult to say. I think, we'll see the street, particularly Wall Street, reappraise this data when they come in tonight. But the recent communications from the Fed, I would characterize as being, there's not the same unilateralism in the communications. They've become a little bit more diverse. They've certainly become a little bit more dovish. I think on the back of this Chinese data, which suggests that the global backdrop in which the US is operating is not as weak as expected, does suggest that the market may bring forward tightening expectations for the Fed. I think Q1 16 will probably definitely firm up as the preferred period for the first rate hike.
What do you make of the latest trend in emerging markets? And after a scary August and a stormy September, October numbers are looking quite encouraging. Most of the emerging markets, including India and Indonesia, they've got inflows, and outflows no longer is a problem.
Well, when we look at the emerging markets and the currencies in particular, it was interesting that, the strength in the Asian currency rally was led by the Indonesian rupiah and the Malaysian ringgit. They had spectacular outperformance as Fed expectations were wound back to no rate hike in the fourth quarter of this year. I think they're probably the currencies you're likely to see will temper their recent rally on the back of this better than expected data from China. To me, the relief rally in Asian currencies looked overdone. They still will face inevitably a Fed rate hike, an ongoing slowdown in China, a difficult global trading environment, and I think, you know, in that environment over a 1 to 2 year period, there probably will be some asset reallocation out of these economies.
Then what's the expectation from the ECB rate decision that's going to come out later this week on Thursday?
It will probably be status quo. I think one of the things we're seeing with those banks which are still quantitatively easing is a realization that each round of quantitative easing has diminishing returns. The first announcement normally has quite an impact. Subsequent announcements or subsequent measures tend to have a more marginal impact. But the European economy is an economy which is recovering. Growth is likely to be stronger in 16 than it was in 15, and stronger again in 17 than it was in 16. And there's very few economies, particularly major developed economies, where that is the case. Inflation is low, but whether quantitative easing in Europe can address an inflation problem which appears to be more globally determined and more commodity price determined, the answer is no. So I think the risk is skewed to the status quo from the ECB.
Many thanks, Glenn, for joining in, giving us a sense of how things are likely to shape up across the globe as well as what the outlook is.
Thank you.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.